Hello and welcome to another video from the Dividend Times. For those of you that don't know me, my name is Lee Wentker, the creator, developer, and publisher of two fantastic proven systems, the Divi-X System, which focuses on wealth generation, and what many of you probably most know me for is Closed-End Fund Mastery, which focuses primarily on high-yield income, principal preservation, with a secondary focus on wealth generation. In this video, I'm going to focus primarily on the Divi-X system. In 2015, I published a book called The Dividend Times, An Introduction to the Divi-X System, for sale on Amazon.com. It's free to read if you currently subscribe to Kindle Unlimited. In that book, I described a system that shows you how to use future cash flows from stocks you're already buying to purchase an even greater number of shares, allowing you to capitalize on dividends and capital appreciation from a greater number of shares using less cash out of pocket. My conviction in this system has prompted me to continue tracking these stocks I wrote about in my book. From time to time, as is the case now, I like to re-examine those stocks to see how well they continue to perform. When I'm doing prep work for these Divi-X updates, I often like to refer back to a review that was left about the book on Amazon, simply stating that company reviews become outdated too quickly. In the book, The Dividend Times, all of the examples I used were limited to 5-year time frames. And the reason I started posting these updates is to illustrate that the first 5 years is just the beginning. In fact, the longer you hold a position, the more profitable it becomes, with certain exceptions, of course, i.e. mergers, bankruptcies, extreme crashes, etc. So in fact, the statement that company reviews become outdated too quickly, actually the opposite is true. They become more relevant. Upon retrieving this review, I was pleased to see that there has since been another review, although I was quickly disappointed once I read it. Folks, I'm a big fan of constructive criticism, and normally I let negative personal criticism roll off my back. But this review is basically a blatant mischaracterization of my book. The person who wrote the review, I know for a fact, has access to my email and my phone number, but instead of reaching out to me to go over what they might have overlooked, they chose to attack my work in a public forum. This, in my view, leaves me no choice but to rebut these criticisms in a public forum as well. I wish I could do this on Amazon, but the site does not give me the option that I know of, so I have to revert to using the YouTube video as my defense. One by one, I'm going to address these comments. First, in the title, they state the book is incoherent. Pretty sure my writing skill is at or above the 6th grade reading level, which, if I'm remembering correctly, is the reading level of a news article. Microsoft's grammar check didn't seem to have any issues with my writing style either, so I think incoherent is a bit exaggerated. Person says it's rambling. Rambling is when you go on and on about a specific topic with no end. Here's a small screen cap of the topic outline in the table of contents. You can see there are numerous topics that span as little as 1 to 2 pages each, hardly indicative of rambling. And in just this small sample size, I see multiple topics that would be of great interest to someone. Isn't leverage risky? The difference between multiplier pick and dividend multiplier, which are essential to the program. Everything shown here under tips, tricks, and ideas. These all seem like very interesting topics to me. Next, the reader gets the feeling that the information in this book could have been summarized in one paragraph, but you won't get it here. Again, going back to our topic screen, Chapter 3, How It Works. Walkthrough from start to finish. It can't be any more obvious than that. Next, a lot of words, but very difficult to come up with actionable information. Popular books like Rich Dad, Poor Dad has approximately 72,000 words. The Millionaire Next Door has approximately 64,500 words. My book only has 53,200 words. A lot of words, less than what is normal, I believe. I will extend an olive branch and state that there is a bit of redundancy in Chapter 2 when summarizing the positions in the book. This is intentional to illustrate the Divi-X system's cookie-cutter approach, which is basically doing the same thing over and over again and getting good results. It also introduces the reader to terms used in the following chapter, How It Works, and regarding the assertion that it's difficult to come up with actionable information, again, see Chapter 3 and numerous other topics throughout the book. Finally, the graphics are also fuzzy and hard to read. I'm going to cede a little ground on this one. Here's an actual picture of a chart taken from the actual proof that I submitted to Amazon's publishing service. My eyes aren't that great, but it is clearly legible. Additionally, right below the chart is a numerical summary of what's in the chart, which are the return results, the most important part. Nothing fuzzy there. Amazon's publishing service is a print-on-demand service. The book isn't printed until it's ordered. Did you receive a copy with low print quality? It's possible. Unfortunately, that's out of my control. My whole issue with this review is not that this person has a poor opinion of the book. The issue is that people might be discouraged from exploring this system simply because the reader thinks the book has too many words and doesn't like the pictures. Nothing to do with the substance of the material itself, which seems to me, based on this review, was skimmed over. And by the way, in the appendix of the book, I offer a link to a manual worksheet and an Excel worksheet for free that walks you through the entire process. For this book to be any more actionable, it would have to fill the forms out for you. Okay, that's enough about that. This is going to be a two-part video series that discusses two completely different approaches to using the Divi-X system. One video is not dependent on the other video, so if you watch this one and choose not to watch the other, or watch the other and choose not to watch this one, you'll still get a clear idea of what the Divi-X system is and what it does. In this video, we're going to focus primarily on the returns of the investments made in the book. The book focused primarily on growth and just touched on high income. In the next video, we're going to focus primarily on high income or high yield. The procedure for growth and high income using the Divi-X system is exactly the same. However, because of the nature of these two different vehicle instruments, the approach is completely different, because when dealing with growth, the upside potential is unlimited, but with high yield, X distributions, the upside is limited. To give you a taste of what will be in the next video, here is a performance chart that I share with subscribers in my weekly newsletter. This is the Divi-X high yield portfolio, which I created back in July of 2023. It compares the Divi-X returns to without Divi-X returns. Currently, the Divi-X spread over without Divi-X is nearly 21%, not too shabby. We also have the returns compared to the S&P 500, indicated by the orange line right here. Generally, it is not common for high yield to outperform growth in the long term. This is evidenced when you look at the returns of the S&P compared to without Divi-X returns. As you can see, high yield is trailing the S&P by more than 14%. But with the Divi-X system, currently the returns surpass the S&P 500 by a modest amount, currently over 6%. Additionally, I would like to point out and put special emphasis on the fact that distributions are not reinvested. Divi-X returns and without Divi-X returns utilize the same exact positions, as well as the same amount of cash invested out of pocket. In the table to the right of the performance chart, I have a small list of the highest performing closed-end funds for the last 3 years, which is just a little bit longer than the existence of the Divi-X high yield portfolio. The highest performing fund, STK, with emphasis on distributions reinvested, has performed by 30.9% compared to the whole of the Divi-X portfolio at 54.8%, with distributions not reinvested. And within the Divi-X high yield portfolio, there is currently a humdinger of a loser, which makes the Divi-X returns all that more impressive. And we'll go over that more in the next video. Also, I do not know if you watched my closed-end fund mastery versus AI video and then the 1-year follow-up to that video, I pitted AI's top 10 picks against closed-end fund mastery's top 10 performers. But I also created Divi-X portfolios for each. We're about 2 years in since both those portfolios were created, and you can see that Divi-X has added an extra 6.92% to AI's performance and an extra 7.29% to CEF Mastery's performance to date. On an unrelated note, closed-end fund mastery is still outperforming AI by 35.23% to 31.98% without Divi-X, and 42.52% to 38.9% with Divi-X. Closed-end fund mastery's top 10 picks have also produced larger and more distribution increases and special distributions than AI's top 10 picks. You may have guessed by now that one of the tools utilized by the Divi-X system is leverage. In this portion of the video, we're going to explore how risky leverage is. Leverage is the process of using resources that are not your own to amplify one's own return potential. A couple of examples are customers pay for a company's growth, or renters pay for one's rental properties. So why not have companies pay for your stock? We are meant to believe that leverage is risky, and for some, when abused, it can break you. But if you were to examine every horror story about leverage that was brought to your attention, you would find that greed played a bigger role in the consequences than leverage did. Leverage just provided the rope. Whether it be the use of other people's money or other people's time, leverage has always been history's greatest wealth builder. To avoid leverage is your choice, but I bet you're using it whether you know it or not. Avoiding leverage may be prudent if it scares you, but it will exclude you from its potential as well. After watching this video, you tell me how risky you think leverage really is. Here are some examples of leverage you're probably already using, but you never thought of it as leverage. Credit card consumption. Oftentimes, credit cards are used for consumable or depreciable purchases and services. Long after the product or the thrill of purchasing the product is gone, the only thing left is your depression for continuing to have to pay for it with exorbitantly high interest rates. Credit cards are often the #1 reason for personal bankruptcies. Now that's risky. The purchase of a car or other depreciating assets, somewhat risky. Transportation to a high-paying job, that's not too bad. Purchase of a television contributing to obesity and a possible sedentary lifestyle, not so good. Cost of energy, repairs, and maintenance. When you purchased your home, you may have borrowed up to 80% of the purchase price. You get possible appreciation, which is less risky. If you're buying at the top, it's a little more risky. In addition to the question mark of will there be appreciation when you decide to sell, you also have the added expense of mortgage, taxes, repairs, maintenance, insurance, etc. And then there's always the possibility of default. The least risky use of leverage is for income generation or asset appreciation. You'll find these in the form of rental properties, a well-run business with a demand, stocks, etc. Another good use of leverage is the Divi-X system. And in this video, we're going to show you how the Divi-X system has multiplied income and asset appreciation. This is one of my favorite charts that I share on occasion with my subscribers. It is an actual 20-year history of a high-yield closed-end fund, PHK. Over the last 20 years, this particular fund has lost 65% of its share price, and through a series of cuts over the last 20 years, has seen its distribution decline by over 60%. Now, because PHK is a high-yield fund, although not as high as it used to be based on its original cost basis, it still managed to produce a meager 5.6% annual average for the last 20 years. However, with the Divi-X factor, those returns nearly doubled to just over 10% a year. It's not stellar, I know, but again, this fund over the last 20 years has lost over 60% of its share price and over 60% of its dividend. So let me ask you, in this particular scenario, How risky was it to use leverage? Okay, on to business. This video is going to provide you with an in-depth look of every dividend-paying DAO component written about in my book, The Dividend Times, An Introduction to the Divi-X System, and the impact the Divi-X System has had on those individual stocks. The reason my book listed every dividend-paying stock in the DAO is twofold. One, I wanted to avoid the appearance of cherry-picking specific stocks that simply made my system look good. Secondly, and more importantly, it's that my system simply works. In this video, we examined those stocks in alphabetical order according to their ticker symbol. So if you do not wish to watch the brief analysis for every stock, you can jump ahead in the video to the symbols that interest you. I would just like to point out that if you do not wish to watch the analysis for every ticker, take a brief moment to just play the video at some of the other stocks along the way to your own, because as the video progresses, I will be introducing new elements that offer more insight into how the Divi-X system actually works and behaves in different scenarios. For example, the stock Boeing. They cut their dividend years ago, and as a result, you can imagine how much that decision affected the share price of the stock. This dividend cut would have forced you to close your position per the Divi-X system, because with no dividend, you can't pay back the loan associated with the stock. But despite that, the Divi-X system still added nearly 200% return to your 655.96 return. The same is true for Disney. They had to pause their dividend for a while, and despite having to let the position go per Divi-X, it still added nearly 40% to your position. One last example would be United Healthcare. United Healthcare just recently had a 56% crash in their share price, but Divi-X still added around 122% to that position, providing an astounding 984% return on leverage, which is what we'll examine when we get to that slide. Feel free to pause the video here if you wish to view the returns. Also in this video, we are going to examine the effect that Divi-X has had on yields as well. Continuing with our United Healthcare example, thanks to Divi-X, United Healthcare also currently enjoys a 3.6% yield on cost advantage over without Divi-X. All the returns you're about to witness in this video are the result of filling out this simple little form when you place your buy order. On the left, you have the most basic of stock information: ticker, purchase date, share price, dividend. On the right, you have a couple of variables that will make all the difference in the world on the added future potential returns from your Divi-X trade. Once you fill out this form, tailored to a risk level that is acceptable to you, you simply sit back and let the magic happen. With the Divi-X system, other than checking on performance, there's virtually nothing else left for you to do. Just a quick product note, the Divi-X system workbook does require manual share price updates, but daily updates are not required. In a very short period of time, I will be releasing the Divi-X dashboard, which will allow you to import all of your individual Divi-X position workbooks into one place and have everything automatically updated at the push of a button. The dashboard currently is ready and working, but I have to throw some tutorial videos together before I can release it. The Divi-X system workbook is currently for sale on my product page at thedividendtimes.com. Okay, first on the list is American Express. I believe Apple is now a DAO component, but it wasn't at the time I wrote the book. What you are looking at here are the returns to date, which is currently about 16 years after the purchase date from the book, plotted on a 20-year chart. It is important to note that for all of the examples shown in this video, returns are cumulative and that distributions are not reinvested. The reason I always put so much emphasis on the fact that distributions are not reinvested is because, in my opinion, DRIPs are an outdated model. DRIPs rose in popularity many years ago when brokers were still charging $50 a trade. Dividend reinvestment plans, or DRIPs, were created to bypass that $50 commission, and as an added incentive, many DRIPs offered a discount by directly investing with them instead of purchasing your shares on on the open market. Problem with this model now is that trades are free. If you're willing to look, or if you're willing to have a stock scanner do the looking for you, you can almost always certainly find a better deal to reinvest your distributions in, even with the small discounts sometimes offered by the stock issuer. Now back to this chart and every subsequent chart afterwards, you will see highlighted the 5-year returns, the 10-year returns, sometimes the 15-year returns when they do not obstruct the view of the current returns at approximately 16 years, which is life to date. In the upper left of the chart, which is another new feature I added to the Divi-X System workbook, yet to be released, is the dividend yield history chart for each position with and without Divi-X, which is conveniently embedded on the performance chart. On the horizontal axis, instead of listing the dates, we list the number of months it took for the Divi-X yield to surpass the all-cash yield or without Divi-X yield. As you can see in this particular instance, it took about 57 to 58 months for the Divi-X American Express yield to surpass all cash or without Divi-X. Now in this current chart of American Express, because we're looking at a 20-year time span, scale does not do the return spreads justice. If we go all the way over to the left for the first 5-year period, Divi-X outperformed without Divi-X 366% to about 301%, a spread of around 65.5%. This 65.5% spread for the first 5-year performance of Divi-X would have added an average of an additional 13% more per year to your returns. But to look at the actual spread on the chart, you would think that there's not much difference at all, but in reality the difference is rather large. At the 10-year mark, that spread widened even further to 98.53%. At 15 years, an even bigger spread at 214.36%. And most recently, as of February 2026, at year 16, the spread is significantly wider still at 338.46%. For the yield on cost without Divi-X, your yield would now be 13.31%. At the origination of this AXP position, the yield on cost for without Divi-X would have been 2.92% versus 1.75% for Divi-X. But after 16 years later, we currently sit with the yield on cost without Divi-X at 13.31% to Divi-X's 16.53%. The reason for the yield shortfall early on in the position is because when you use the Divi-X system, you are sacrificing short-term yield potential with the exception of higher yields and greater share price appreciation on a greater number of shares in the future. The actual reason for the discrepancy in yield in the beginning is because of interest expense. The interest expense is incurred because of the creation of a margin loan obligation, and I use the term loosely, which uses the future cash flows from dividends to finance more shares today. How much leverage? You would be surprised at how little, but let's continue. Converting our percentage returns to dollars, you can see that after 16 years as of February 2026, Divi-X outperformed without Divi-X, or shall we say all cash, $37,000 to $30,000. Can you believe that? An extra $7,000 in your brokerage account simply by entering a couple of keystrokes when you make the purchase and practically doing nothing but waiting. Briefly going back to our buy order form, you can see that one of the variables I have listed here is return rate. This is a number that would be input by you, which would indicate your preference for a minimum acceptable return rate. For me, my default rate is a 9% compounded annual growth rate. So this figure doesn't just account for the 9% of my initial cost basis, it also demands a 9% return return rate on my investment's growth as well. Going back to the return scenario chart for American Express, that compounded annual growth rate is represented by the maroon line you see down here. Comparing our actual returns to our expected 9% compounded annual growth rate, you can see that American Express, with or without Divi-X, is outperforming expectations considerably. The upward slope that you see here just to the right of our actual returns is just a continuation of our 9% compounded annual growth rate on top of our current returns. So for example, based on current returns and the continuation of our 9% compound annual growth rate, by the end of the 20-year window, our returns are expected to be at about $50,500 for Divi-X and $41,200 for all cash. But if history is any indication of future returns, those projections could be considered conservative. Next is Boeing, ticker symbol BA. As I mentioned earlier, Divi-X would have had to exit this position when the dividend was eliminated. The logic is simple. If there's no income coming in from dividends, the investment can't afford to pay the interest expense. There is a loophole around this. If your conviction in Boeing is that strong, you could use the distributions from other securities in the portfolio to pick up the slack, but that wouldn't be using the Divi-X system. That would be you exerting a bias. Now, at the time of sale, Boeing's returns were Divi-X 843% and without Divi-X about 656%. Yield on cost for all cash at the time of sale was 17.01% for all cash and 22.13% for Divi-X. Despite Boeing's woes in having to eliminate their dividend, all cash and Divi-X returns far exceeded the 9% compound annual growth rate expectation of around $11,400, with Divi-X pulling in $38,400 and without Divi-X pulling in $30,670. Caterpillar, ticker symbol CAT. Despite the chart's compression of scale after each 5-year interval, here, it is evident that the Divi-X advantage broadens wider and wider. As of February 2026, Divi-X holds nearly a 1,100% advantage over all cash. Yield on costs currently sits at 26.9% for Divi-X and 17.95% without Divi-X. Dollar-wise, Divi-X holds nearly a $24,000 advantage over all cash, and both far exceed our 9% compounded annual growth rate. Cisco, ticker symbol CSCO, was a Dow component at the time I published the book, but it did not pay a dividend, so there was no analysis done on it. I did run a Divi-X workbook on Cisco based on its newly announced dividend of only 6 cents a share. Back then, that 6 cents a share represented a yield on cost of 1.38%. Using that 6 cents a share to create a Divi-X position would have reduced our yield on cost to a mere 0.02%. Now look how powerful the Divi-X system is. With that 6 cents a share dividend, after 5 years, it added an extra 10.7% return to Cisco's returns. For 10 years, almost 47%, and as of February 2026, almost 95%. That is remarkable. And as of February 2026, look at our yield. We have grown from 0.02% all the way up to 11.47% versus 9.45% for all cash. I failed to include a dollar return chart for Cisco, but the actual dollar returns are Divi-X $9,595 to $8,238, a difference of about $1,360, all from a mere 6 cent dividend. Chevron, ticker symbol CVX, as of February 2026, Divi-X 361%, without 273%. Divi-X yield on cost from 2.65% to 13.7%. all cash from 4% to only 10.05%. Notice that in the first 5 years, both with and without Divi-X, Chevron exceeded my 9% compounded annual growth rate. However, after the first 5 years, only Divi-X would have given me a shot of at least achieving my goal of 9%. And looking at this chart going forward, it appears that only Divi-X gives me a real shot of making it back to my goal of a 9% compounded annual growth rate. Now in this next slide of Chevron, we're going to zoom into the first 5 years so we can focus on another little feature included in the Divi-X workbook. If you notice in the top right of any chart, you'll see circled the rule of 72, and just to the left of that is a number. According to the rule of 72, if you take any dividend and divide it by 72, it will return how long it will take for you to double your money based on the dividend. In this case, it would be a smidge just over 18 years. Now, that is a nifty, nice to know statistic when investing in dividend paying securities. However, it's not really very practical because it fails to take into account a stock's moving share price, and then the case where leverage is used, the added interest expense. In the Divi-X System workbook, all of these variables are accounted for in the return scenarios chart. If you look at this lower horizontal bar, it represents our baseline investment or actual cash out of pocket. The horizontal line above that represents the rule of 72, or in other words, the doubling of your investment. Also represented are the cumulative returns with and without using Divi-X, which does take into account all those variables. I just mentioned the dividend, and in the case of Divi-X, less interest expense. With the use of these simple little tools, it is quite easy to see when you actually double your investment when accounting for all these different factors. And most often what you'll see, not always, but most often, is that the Divi-X returns double your investment considerably sooner than simply using all cash. You can see here, and these are actual returns, that Divi-X doubled an investment in Chevron in just 3 short years after opening the position in August 2012. Simply using all cash would not have doubled your investment until 11 months later in July 2013. DuPont D&M's ticker symbol DD. I had a little trouble reproducing historical return data for this stock because share prices did not line up, and I couldn't find any evidence of a stock split. Turns out that DuPont had a merger which it completed in August of 2017 and kept the name. As a result of the merger, it created a completely different company, not necessarily industry-wise, but financially, and because the financial makeup of the company had shifted so dramatically, this would have prompted a sale per the Divi-X system. So the end result leading up into the merger would have returned you 416% compared to 339% without Divi-X, and you would have had a yield on cost of 25.7% compared to 20.8%, which unfortunately ended when the combined company would have likely had a new dividend rate, if they had a dividend at all. I didn't bother to look this up. For Disney, sometime in 2019, they eliminated their dividend, which would have required us to sell as well. At the point of sale, the Divi-X returns were 361% to 323%, with the yield on cost favoring Divi-X at 5.17% compared to 4.56%. Disney did resume its dividend in December 2023, at which point, if one chose to, they could initiate a new position in Disney using the new dividend of only 5 cents a share semi-annually. In the yield on cost history chart, you can see that 5 cents a share represented a 0.65% yield on cost at the time, and for Divi-X, the chart actually indicates that yield on cost was 0%. This is actually a decimal issue. The actual yield on cost for Divi-X at the time of this new position was only 0.0038%. Now, we're too early into this position to draw any conclusions on its potential outcome, but already you can see through a couple of distribution increases, the Divi-X yield has surpassed the 1.62% without Divi-X at 1.76%. As far as actual returns, as of February 2026, it's pretty much neck and neck. 15.74% with Divi-X and 15.89% without. General Electric. This is a very interesting situation here. We're going to begin our brief analysis of this position using the yield on cost history chart. Represented in this chart is not one but two dividend cuts represented here and here, which is obvious by the decline in the series lines. After the first initial dividend cut, the associated margin interest expense was still covered as well as continued to pay down the principal. These two conditions having been met, after a dividend cut would give you the option to continue to stay in the position. Unfortunately, staying in General Electric would have eventually led to another dividend cut, which would have forced an exit out of the position. General Electric at the time did not eliminate the dividend, it just wasn't enough to cover the interest expense. Post the first dividend cut, Divi-X would have gone from 8.94% down to 4.47%. After the second cut, it doesn't matter because we had to sell the position. Post exit final returns were Divi-X 21.38%, without Divi-X 22.19%. And just to point out, returns are in the face of a near 120% decline in share market price, from 85% all the way down to negative 32.75%. Ironically, after the second dividend cut in General Electric, which would have forced someone to close the position, they could have then taken the new reduced rate of 6 cents a share and opened a new position in General Electric. This new position would be about 7 years old today. The 6-cent distribution would represent a 0.45% yield on cost without Divi-X and a 0.01% yield on cost for Divi-X. As of today, those yields have flipped. Divi-X 2.84%, without Divi-X 2.68%. This small 6-cent a quarter distribution would have levered you into this position at only 5.59%. That paltry 5.59% margin amount has currently added 25.8% to current return. Goldman Sachs, ticker symbol GS, is another interesting case study. This position would have been created near or at the end of the great market crash in 2008. Those of us old enough to remember know that no one and nothing was spared, but banks took the brunt of it. And as you can see from this slow to no growth span of time in the chart from the beginning of the position to practically 11 years later, it is evident that the event in 2008 had a long-term lingering effect on Goldman Sachs stock. But what is most fascinating about this chart is what you cannot see. If someone had the misfortune of being in this position around 2009, the only consolation as a shareholder would have had is that at least it pays the dividend. That dividend, while better than nothing, was practically, well, nothing. And as you can see from the yield on cost chart, while there were significant increases made to the dividend, yield practically went nowhere for nearly 122 months. Now, Divi-X would not have been able to escape this reality, but all the while the share price and the dividend was practically going nowhere, Divi-X was busy attacking the outstanding principal on the margin loan. So when Goldman Sachs' share price started to show signs of life, that increased equity in the position from the paid down principal on the margin loan would have propelled you past the all-cash position. The same is true for dividends when Goldman Sachs actually started making meaningful increases. Notice in the yield on cost chart after the first meaningful dividend increase. The Divi-X yield on cost went from trailing to surpassing after the 122nd month. As of February 2026, after all of that stagnant activity over the years, Divi-X added over $9,300 to your position for nearly an extra $600 a year. And we are currently well above our 9% compounded annual growth rate target, despite having lagged it for the majority of the position. Up to this point, we've been focusing primarily on overall returns, but now we're going to segue into another statistic statistical little nugget: the return on money you actually borrow for the position. Over here on the left, I've worked up a little summary for us. When this position was created, Divi-X leveraged into it at 11.93%. In other words, of the total purchase price of 100 shares, 11.93% of it was borrowed money. That 11.93% of borrowed money equaled $1,750. That 11.93% of borrowed money earned us an extra $9,353.95. That's in addition to the standard returns earned from all cash. Dividing the leverage amount of $1,750 into the extra $93.53, using the Divi-X system, you would have earned a 534.5% return on leverage. Not too shabby for money that's not even ours, right? This is just another look at the first few years of the Goldman Sachs position. In the lower right-hand corner is a more close-up view of dividend growth, or lack thereof, in the beginning. Because the dividend on Goldman Sachs was so small that it only levered you in at around 11%. The early turmoil of the position immediately after the crash in 2009 added very extra little volatility to the position. For example, the period of around December 2010 through July 2012, there was roughly about a 60% swing to the downside in the company's share price. Yet that only negatively affected the position about an extra 7% over just an all-cash position, 39% to 32%. Here's a feature in the Divi-X System workbook that measures the dividend growth rate with and without Divi-X. Still looking at Goldman Sachs, represented by the purple bars is dividend growth without Divi-X, and the green bar represents dividend growth with Divi-X. This chart serves two purposes. First, and probably most importantly, shows the company's rate of growth for its dividends. When investing using the Divi-X system, you would like to find stocks that have a steady percentage growth in its dividend. Although it is not essential, my experience has shown that greater success is aided by a robust growth in dividends. As you can see here in this chart, Goldman Sachs fails to meet that qualification. While in year 4, the dividend significantly increased over year 3, in year 5 it significantly pulled back again, and the same goes for the Divi-X. Had we done a 5-year yield history on the position of Goldman Sachs from the 5-year period leading up to the crash in 2008 and 2009, we would have avoided that position. Even though the position was ultimately successful, how many years did we have to wait for that success to come? The chart you're looking at now represents the last 5-year performance of Goldman Sachs, which is pretty much when the bulk of the breakout started to occur for the stock. Looking at the yield on cost historical chart in the upper left, you can see that yield growth is decidedly more aggressive over the last 5 years than it was in the first 5 years of this position. This is one tip to help you make better purchasing decisions, which could help you avoid nursing losses for a considerable amount of time before the stock comes back in favor again. Home Depot, ticker symbol HD. Home Depot is a Divi-X darling. Returns as of February 2026, Divi-X 2429.97, without Divi-X 1820. Yield on cost, Divi-X 52.24, without 38.97. Cash out of pocket on this position would have been $1,761. The amount leveraged would have been $600. Return on leverage or borrowed money equals 1,785%. Here's another new feature I just added to the Divi-X workbook. On the home page of the workbook, I added a statistic of how many shares the borrowed money has paid for since the position was purchased. Not the total return, just the portion that was borrowed. For example, in this screenshot, you can see that the $600 that we borrowed way back in 2009 paid for 25.4 shares of our our 100 lot of Home Depot. Yet to date, that $600 borrowed has actually paid for more than 75, nearly 76 of the 100 shares that we owned. Another way to look at it is the extra $10,741 earned from our $600 of borrowed money is now the equivalent of 75.8 shares of Home Depot. That's a staggering number. Remember, this represents a 1,785% return on leverage. IBM is another stock where a 5-year history chart of the dividend growth rate would have caused you to pass on this one. Even though ultimately the advantage goes to Divi-X, 215% to 190%. Just like Goldman Sachs, look how long you had to wait for the stock to start showing any signs of life. And after 16 years, is 215% really worth it? I think by now you can probably interpret these charts on your own, so if you wish to explore a little more detail about the IBM returns, you can pause the video. This chart of the IBM dividend growth rate is a better example of how to use this chart. You can see that for years 2, 3, 4, and 5, that while IBM did increase its dividend every year, the rate of the increases were on a downward trajectory. Another giveaway that this is a stock you might wish to have avoided at the same time is that the Divi-X yield is also following the same trend as without, but also that the Divi-X yield spread is narrowing year after year after year. This is indicating yield growth compression, meaning that it is getting harder and harder for the company to raise its dividend. Intel Corporation, ticker symbol INTC. Again, and I mentioned this in a previous slide, that Intel, along with Goldman Sachs and IBM, are stocks where the dividend rate of growth chart would have told you to take a pass on. That aside, had the investment been made around month 155, Divi-X had a yield of 5.31%, which surpassed without at 4.61%. That was pre-dividend cut, which then dragged the yields down to Divi-X at 1.87% and without Divi-X at 1.62%. As of February 2026, Divi-X has a 12% lead over without, which isn't much, but as I just mentioned, viewing a dividend growth rate chart would have had you avoid this position altogether. But as you'll recall, referring back to our examination of Goldman Sachs, even though the stock isn't currently going anywhere, Divi-X is still knocking away at the outstanding principal on this position. So should there ever be a meaningful breakout, Divi-X will be the clear beneficiary. One last material note on this position before we move on. In the Divi-X System workbook, there are 4 payment options to choose from. You'll have to read the book to learn more about those options. I only point this out here because when the book came out, Intel used the payment percent option, which is basically where a user decides how much of the outstanding margin loan balance you wish to allocate a dividend portion to paying back every month. It works exactly like a credit card where your monthly payment amount is determined by how much of an outstanding balance you have on the credit card. In the example I'm showing you now, I used the all div feature or all dividends, which basically means all the dividends received immediately go towards paying down the principal on the margin loan. Using the payment percent function on this particular investment would have forced you to close out the position because by the time the distribution was cut, there still would have been interest payments that exceeded the monthly distribution amount received. Using the all div feature, which is my personal preference, pays down the outstanding margin loan quicker, which cuts back on the interest expense. Here are Intel's dollar returns. You can pause the chart and examine it if you wish. Johnson & Johnson, ticker symbol JNJ, returns as of February 2026 are Divi-X 441%, without Divi-X 350%. Yield on cost, Divi-X 10.42, without Divi-X 8.09. Johnson & Johnson's return on leverage using Divi-X is is 316% on $1,440 borrowed. And again, only with Divi-X are our returns exceeding our 9% compounded annual growth rate target. JP Morgan, just like Goldman Sachs, fell out of favor during the great financial crisis of '08 and '09. However, JP Morgan, I believe, had a stronger balance sheet, and if I'm not mistaken, they were actually buying assets from other failing banks at the time. As you can see from the yield on cost historical chart, JP Morgan has been rather stingy with their dividend increases, although they did start to step it up after month 100. JP Morgan, as of February 2026, has fared much better than Goldman Sachs. The Divi-X advantage is not as bountiful as other positions in this demonstration simply because of the poor dividend growth rate, but ultimately Divi-X is the clear winner in both returns and yield. JP Morgan's stingy yield would have only levered us in at only $250, which equates to a leverage position of only 5.56%. That $250 of borrowed money would have earned us an extra $1,707 for a return on leverage of 693%. That is not bad, and this is a perfect example for those of you that are skittish about using leverage that you do not have to bet the farm. You can scale it to what you're comfortable using, and with the Divi-X system, the company pays for it. Coca-Cola, one of Warren Buffett's favorites. As of February 2026, Coca-Cola with Divi-X has about a 68% return advantage and a +2 yield on cost advantage. Return on the $587 leverage has produced a 242% return. Just to take a moment to zoom into the first 5 years of our Coca-Cola investment. Based on Coca-Cola's initial yield on cost of 3.29%, the rule of 72 states we would double our money in nearly 22 years. However, with Divi-X, we doubled our investment about 3.5 years later in April 2016, and simply using all cash would have doubled your investment 3 years later than that in April of 2009. McDonald's, another Divi-X darling. Currently, Divi-X holds a decisive 112% plus lead over all cash, as well as a 2% plus advantage in yield on cost. The position was levered in at 20.78% using $1,467, which produced an extra $6,293 in returns for a return on leverage of 429%. 3M Corporation, Divi-X advantage currently at 76% plus. Yield on cost advantage, despite a dividend cut back in month 178, is 1.46% at 6.38% to 4.92% without Divi-X. Return on leverage, 257%. For Merck, as of February 2026, Divi-X is outperforming all cash by 118% at 450.75% to 332.65%. Yield on cost for Divi-X is currently 13.42% versus all cash at only 9.59%. Notice in this percentage return chart, and the dollar chart for that matter, Divi-X separates returns in blocks of 5-year increments. The signature pattern of a successful Divi-X trade is an ever-widening spread over all cash. You can see here after 5 years, Divi-X had a 21% advantage. After year 10, a 50% advantage. After year 15, a 77% return advantage. And here we are today, all but 1 year after the 15-year mark, and that spread has widened even further to 118%. If things continue to progress smoothly with this stock, can you imagine where it will be when it reaches year 20? The signature pattern for Divi-X doesn't just apply to 5-year increments either. If you look at the box on the left, whether it's the 1 or 5 year, the 2 or 10 year, the 3, 15, 4, 20, or 5, even 25 year, and so on, the pattern is generally the same, an ever widening spread. For example, if we go back to the 5-year performance history of Coca-Cola, you can see how narrow the spread is right out of the gate. And then the spread widens as we get to approximately the end of year 1. And then by the end of the 5th year, you can clearly see that the Divi-X spread over all cash is considerably higher than after the first year. Now, there are no guarantees in investing, and in some cases, as was with the case of Goldman Sachs, it might not be immediately evident that your Divi-X investment is progressing on the right track. But again, if you recall, as with Goldman Sachs, the dividend growth rate would have steered you clear of that investment in the first place. However, in the presence of this signature pattern, you can take comfort in the fact that your trade is displaying the pattern of a successful Divi-X trade. And you will discover in the following video that this pattern applies to high yield investing as well. Microsoft, ticker symbol MSFT, would have gotten off to a slow start as Divi-X carried just under a 6% lead over all cash after 5 years. A lot of this was contributed to the fact that Microsoft only had a 1.68% yield on cost, giving Divi-X only a 0.92% yield on cost. Now, based on what I just told you about the Divi-X signature pattern, because Microsoft had such a small yield at the outset, it may seem as though that the signature pattern is not present until after year 10 and beyond. And again, the 20 years chart scale minimizes the significance of the difference, but the pattern is definitely there. After year 5, the Divi-X spread was only around 6%, but at year 10, that spread increases to almost 63%. And as of February 2026, that spread now sits at just over 157%, and the yield spread is about 1.5% greater than all cash. To purchase these 100 shares of Microsoft, you would have paid $2,749 out of pocket and leveraged in with margin at $346.67. As of February 2026, your return on leverage would be 1,335%. Another beautiful thing about the Divi-X system is that the longer you hold a successful Divi-X position, the wider your margin of safety when things take a turn for the worse. At the height of Nike's market price success, with dividends not reinvested, all cash reached a return of 831%, with Divi-X carrying a 176% return spread at 1,007%. Unfortunately, things don't always work in our favor. Just recently, Nike share price was hit with a near 65% decline. An all-cash position would have lost almost 500% in value, from 831% to now just 303%. It is true that Divi-X would have taken a bigger hit, falling from 1,007% to about 360%, an unrealized loss of 647%. That is an unrealized loss 147% greater than all cash, but you would still be outperforming all cash by almost 57%. And either with Divi-X or without, despite performance being beaten and bruised with Divi-X, you still have at least a 2% spread in yield on cost. Despite a near 65% decline in share price, if not for Divi-X, we would not have performance that kept us close to our 9% compounded annual growth rate target. From the Divi-X high in Nike of nearly $17,000, of the $350 borrowed for our 100 share purchase, our return on leverage would have been a astounding 765.3%. Post the nearly 65% decline, and that return on leverage percentage reduces to still an impressive 250%, considerably less, but not an insignificant sum. Similar to Nike, Pfizer has also recently experienced experienced a significant drop from all-time highs, nearly 56%. After the decline, Pfizer with Divi-X still has nearly a 72% advantage over all cash. Additionally, Divi-X also carries a 43% bigger yield than all cash, with 15.58% to 10.86%. Return on margin for Pfizer is currently 138.8%, down from 322.8% at its highs. At this point in the presentation, I just want to point out that throughout this presentation, Divi-X returns have outperformed all cash regardless of how big or small. And throughout the entirety of time these positions would have been held, even though Divi-X may not have been in the lead at all times, there were always points along the way where extra profit earned by Divi-X could have been taken. So even if you find yourself in a position that doesn't seem to be performing as you had hoped, there's a good chance that if Divi-X isn't currently leading, it could take the lead again in the future, at which point you can assess whether you wish to stay in the position or get out. Naturally, the same can't be said if a stock is undergoing adverse negative events such as a bankruptcy. Procter & Gamble is another stock that, had you did a 5-year dividend growth rate chart, you would have passed on. And as you can see here, even though Divi-X has a respectable 50.8% lead over all cash and nearly a 2% spread in yield, Procter & Gamble with and without Divi-X has failed to come close to our 9% compounded annual growth rate return. And if you recall, with the exception of Microsoft, the same was said about Goldman Sachs and Intel Corporation. In all cases, Divi-X carried the lead, but overall performance was subpar. I believe this illustrates that a mediocre 5-year dividend growth rate can be used as a precursor to spot lackluster future performers. That is not to say that the dividend growth rate cannot accelerate in the future, at which point an investment would be preferable, just not right now. If, however, your return expectations are lower than my expected 9% compounded annual growth rate, then by all means have at it. The SPY ETF was not included in the book. I snuck it in here to illustrate to someone who's not comfortable picking their own stocks and chooses to use an index fund instead. The Divi-X system still works. As of February 2026, returns are not shabby at all. All cash at 673%, with Divi-X 775.58%. Yield on cost, Divi-X 9.33%, without Divi-X 8.05%. Historical yield on cost for SPY is a bit schizophrenic because the dividend payout in SPY is seldom the same 2 periods in a row. But you can see for the bulk of the duration of this position, the Divi-X yield on cost exceeded all cash and currently sits at 9.33% compared to 8.05. I do have one crucial note to make about variable rate dividend payouts. When at all possible, using the Divi-X system, try to pick a security that pays a consistent dividend payout. If only for the simple ease of tracking performance, that would be reason enough. However, especially in the case of ETFs, during a boom cycle, there's a good likelihood that even though the dividend is different every payout, over a period of time, the payout growth rate will trend up. That's great. But when the bust cycle comes, the opposite can be true and the dividend payouts start trending downwards. If you make a Divi-X investment during the boom cycle when dividends are trending up, you may be forced to exit the position when the bust cycle occurs and the dividends start to trend down, which may eventually at some point fail to cover the associated interest expense on margin. Technically, you could still hold the position, but at that point, margin is not working in your favor anymore, and it is working against you. As of February 2026, SPY ETF with Divi-X added an extra $8,732. Levered in at $1,354.67. Your return on leverage is 644.6%. Here is an illustration of typical yield behavior using the Divi-X system. In the chart above, you're already familiar with. In the chart below, We are measuring the yield spread and the rate of incline in the Divi-X yield spread. As I mentioned earlier in the presentation, when you take out a Divi-X position, you are sacrificing short-term yield to acquire more shares, which, if all goes according to plan, you will gain the benefit on both the appreciation of additional shares and the dividend from those extra shares, which will eventually propel your returns and your yields considerably higher than cash alone. Here we are going to dissect the yield life of American Express over the last 16 years. At the time in the presentation when we reviewed the chart for American Express, we concluded with the fact that Divi-X has a 16.53% versus all cash at 13.31% for a 3.22% Divi-X yield advantage. Now, what I am about to break down for you is what you would expect to occur in any future position that you would take. First, we already have established that with each new Divi-X position, you are incurring margin. Margin is a loan. The broker will automatically withdraw the interest expense on the outstanding margin balance every month, but we do not want to carry a margin loan on our positions in perpetuity because, as we witnessed in the case of Nike and Pfizer, rough times will eventually hit. Staying consistently extended for the full margin amount when those tough times come can be disastrous. Because Divi-X will only let you borrow as much as the dividend can afford, but even in those circumstances, hard times can wipe out years of gains. We wish to avoid that. The Divi-X System workbook creates an amortization loan for every individual position you take. Similar to your mortgage, every month a dividend is received depending on which payment option you selected, payment percent, all divs, or fixed payment. A portion of those dividends will cover the interest expense and a small portion pays down the associated principal. As time progresses, the interest payments get smaller and the pay down of principal gets bigger until eventually the loan is paid off. This is the pattern that you are witnessing in the first 2 to 3 years of your new Divi-X position. If you look at the incline of the yield spread between Divi-X and the all-cash position, you can see it appears that it is taking an escalator up. And the reason for that pattern is because with every dividend, less is going towards interest and more is going towards principal. Once you own that additional principal, which is technically a bigger stake in the shares that you purchased, more of those dividends go in your pocket and not to the broker. During the payoff, you may see small spikes or maybe even declines in the rate advancement, and these will occur as a result of either dividend increases and cuts or interest rate increases or cuts. If we refer back to the yield history chart, at the top for AXP, you can see the little escalator movement up until about the 88th month. And you can see that while still paying down the loan, the green line, your Divi-X yield, exceeded the purple line, or all cash. So it's not like you have to wait until the entire margin loan is paid off before your yields exceed those of all cash. Once the associated loan is eventually paid off, then you'll see a flattening in the yield progression. At this rate, interest rates no longer have an effect on your yield, only dividend increases and dividend cuts. In the instance of dividend increases, you'll notice that it no longer appears your yield is taking the escalator up, but now taking the stairs up. And depending on how robust the dividend growth rate, the bigger those steps become. Again, looking at American Express, which obviously has a dividend growth policy, you can see that all cash is taking baby steps and Divi-X is taking bigger steps. We can confirm that by again referring to the chart below. You can see that back around month 125 into the position, the Divi-X yield spread over all cash was 1.69%. But then at month 155, the yield spread increased to 2.04%, then 2.36%, 2.75%, and here we sit at 3.22%. The reason this phenomenon occurs is because because after your shares are paid off, your initial investment in American Express is significantly lower than someone who purchased the same number of shares using all cash. When the loan is finally paid off, you own the same number of shares as someone who paid all cash, even though you paid less money for them. Collecting 100% of the dividend from 100% of the shares that you now completely own represents a larger percentage of a return on investment than one who paid all cash. Say, for example, someone pays $1 for a share and you buy that same $1 share, but you put 50% down and borrow 50%. When that loan is paid off, you will now fully own that $1 share that you paid 50 cents for. The cherry on top is that $1 share pays a dividend. Just for fun, we'll say $1 a share. Now that you own that $1 a share for only 50 cents, your yield on cost is 200%. $1 divided by 50 cents versus the average investor who paid $1 all cash, whose yield on cost is only 100%. $1 divided by $1 is 100%. Feel free to pause the video to take a closer look at the math. AT&T, as of February 2026, Divi-X 210.49 versus 131.72. Yield on cost, once upon a time, was Divi-X 15.87%, all cash 8.65%. Post dividend cut, Divi-X currently sits at 8.55%, without Divi-X 4.66%. Despite AT&T being at one point a dividend darling, its fall from grace and being booted out of the Dow a few years ago still has allowed you to double your money considerably quicker than without Divi-X, but your end result is still considerably less than the 9% compounded annual growth rate. Travelers Insurance, as of February 2026, Divi-X 698%, without Divi-X 572%. Yield on cost, Divi-X 10.7%, all cash 8.67%. Well above our 9% compounded annual growth rate with an extra $5,200 under the Divi-X column. Return on $960 in margin equals a return on leverage of 541.39%. United Healthcare is a stock that has also just recently undergone significant woes with a near 56% decline in share price. Nonetheless, Divi-X has managed to hold on to 122% edge over without. Yield on cost, Divi-X 32.77%, without 29.17%. Both very impressive. Despite the recent crash in share price for United Healthcare, both with and without Divi-X significantly outperformed the 9% compounded annual growth rate. Pre-crash return on leverage was 1,406.75%. Post-crash return on leverage is 984%. Visa is another stock that had a very small dividend at origination. It would have levered you in at only 6.94%, but still giving you a 105.5% advantage over all cash. And despite having a yield not even worth mentioning at the time of origination, here we are several years later and Divi-X is edging out all cash by just under 1%. Despite an unbelievably low amount of leverage at $156.50, return on leverage is a very satisfying 1,415.4%. Verizon, like AT&T, used to be well known for its above average dividend, but unlike AT&T over the years, Verizon has managed to hold itself up better. Just a quick note, if you decide to use the Divi-X system, especially if you're new to using leverage, when you take out a new position, you will probably obsess over the day-to-day activity early on in the investment stage. Don't. It's not helpful. In the first 1 to 2 years of a new position, it will not be uncommon for your Divi-X position to constantly be duking it out with all cash for a slight edge in returns. The process has to play out. If you think you're going to panic the first time all cash takes a lead over Divi-X, you're better off not using leverage at all. Whenever I enter a new Divi-X position, position, I'm looking no less than at least the first 5 years in advance. And even though the numbers in my mind won't exactly match up to what eventually might be the end result, it's the return and the yield spread after the first 5 years that I'm envisioning. In other words, when I make a new investment, I'm not seeing this or this. I'm looking way ahead to this and this. As of February 2026, Verizon's return on leverage of $1,266.67 is 155.7%. And just a little reminder that distributions in all of these examples are not reinvested. Walmart, as of February 2026, 781% to 669%, with a yield on cost advantage of nearly 1% to Divi-X. Return on leverage for Walmart is 641.5%. Exxon is another stock that you would have avoided had you done a 5-year annual dividend growth rate chart. And again, the dividend growth rate chart does not indicate that you should not ever take a position in a particular stock, just not now. Exxon was pretty much a do-nothing stock for a lot of years until the year 2020, when the price of a barrel of oil actually went negative for the first time in history. At that particular point in time, Exxon's share price declined 54% below our original entry price. Since Exxon up to that point was pretty much a do-nothing stock, Divi-X was not able to benefit from a widening return spread as we have witnessed in the examples of Pfizer and United Healthcare. At the height of the 2020 crisis, when the price of oil went negative, the 54% decline in share price caused our Divi-X returns to dip below all cash by just a mere 8%, at negative 11.72 for all cash and negative 19.8 for Divi-X. For a stock that basically did nothing for several years and then crashed, in my opinion, that is extremely impressive. And the reason the losses were mitigated to just negative 19.84% was because of the phenomenon we discussed when we reviewed JP Morgan. The constant pounding away at the outstanding principal of the underlying margin loan associated with the stock. Since then, as of February 2026, Divi-X has taken a lead over all cash at 205% versus 178%, with a yield on cost of 6.88% for Divi-X and 5.8% without. The breakout on the percentage chart looks a little bit more impressive than it does on the dollar chart. Exxon's run-up back in share price since 2020 still has a trailing hour 9% compounded annual growth rate by quite a bit. Our return on leverage percentage is 146.29%. Now, just to close out, a quick summary of the investments we've reviewed. In all, we have a total of 32 investments. 31 of those 32 investments were Divi-X winners, or 97%. The new second position in Disney is too soon to determine who the clear winner is going to be. The without Divi-X winners is 1, and if you can call it that, GE, 22.19% all cash versus 21.38% with Divi-X. Divi-X losers, CGE above. Negative returns, 0. And then just some quick summary stats on the overall Divi-X portfolio of the positions that were written about in the book. The current yield for the whole portfolio is Divi-X at 11.39, without Divi-X 8.97%. The total leverage percentage when we took out the portfolio positions were 17.5%. It currently sits at 0.12%. In other words, everything is almost completely paid off and owned free and clear. The capital appreciation without Divi-X is $466,000 compared to Divi-X at $551,000. Cumulative dividends, Divi-X has earned around $17,000 more in dividends than without, and that figure will continue to grow as time progresses. And now the original dollar amount in leverage was $24,662 for all positions. It currently sits at $754.97. So after seeing all of this, how risky do you think leverage really is? This This concludes our review of the positions in the book, The Dividend Times, an Introduction to the Divi-X System. Stay tuned, date to be determined, for part 2 when we examine all of the positions currently in the Divi-X high yield portfolio, where we'll examine different aspects of the Divi-X program and what the differences are between growth and high yield. Thank you for watching.